In trading, you can find dozens of chart patterns and candlestick patterns, but professionals use only a few basic ones. Reason is simple. Pattern itself means nothing. What matters is market context, where price is, what structure formed, which participants control market. Today, we'll cover 5 working patterns that appear regularly and let you read participant behavior. These aren't magic signals, but repeating market situations that give statistical advantage. If you're following our course, subscribe to the channel and check out Strifor's Telegram daily market updates. Link in description. Pattern 1. Buyer capitulation in range. Market in range. See strong move up, but it doesn't continue. Price doesn't hold above. First important signal, aggressive buying appeared, but market didn't support it. Price returns to key level where impulse started. Consolidation at level, then strong impulse breakout down. Why? Aggressive buying on first impulse shows level was actively defended. But when price returns and gets no support, buyer capitulation happens. Longs close, stop orders trigger, new sells activate. All this creates impulsive move down. Situation when price goes where largest number of stop orders and new positions concentrated. Market moves to zone of maximum pain for participants. First strong price stop, large interest appeared at level, then buyers show initiative. But this may be correction before new drop, so wait for confirmation. Sellers try to push price down again, but selling actively bought. Meanwhile, new sellers appeared on market, opened short positions. When price starts rising against sellers, they have to close positions. This is short squeeze. Sellers forced to close positions with buys, which strengthens price rise. That's why, after liquidity grab, we often see strong impulse up. Pattern 3. Buyer capitulation at level. Price drops to interest level. First reaction happens, buyers at level indeed exist. Continue observing. Second buyer reaction appears. In previous example, such situation led to short squeeze and rise. But here different. Buyer can't develop movement. His initiative gradually suppressed by sellers. At moment of consolidation, breakout price starts falling with impulse. This is buyer capitulation. Those who bought level start closing positions, strengthening move down. Pattern 4. Breakout preparation. Common beginner mistake, taking levels too literally. Resistance means sell, support, buy. But movement context much more important. After rise, market transitions to range. Selling appears but doesn't lead to strong drop. Price returns back to range. This means sellers couldn't push market. Essentially, liquidity grab happening. Price approaches resistance. Important not to rush. First breakout attempt often ends with pullback, then market makes second attempt. And exactly at this moment, impulsive breakout happens. Aggressive buyer cleared limit sell orders that were at level. Pattern 5. Price rejection above level. In previous example, market accepts price above resistance, but sometimes opposite happens. Market doesn't accept price above level. Price tries to hold above resistance, but movement structure starts breaking. See? Impulse up, pullback, another impulse attempt that fails. Market doesn't support this movement. First signs of seller activity appear, then small consolidation forms. After this consolidation breaks down, strong movement appears. Classic situation of price rejection above level. Essentially, this is second seller reaction that triggers move down. Practice assignments. Practice. 5 assignments on Strifor demo account, 1 for each pattern. First, find buyer capitulation in range. Strong impulse up, price didn't hold, return to level after consolidation breakout down. Answer, why didn't first move continue? What happens with buyers when returning to level? Second, identify liquidity grab. Price stop, first buyer reaction, attempt down, selling bought, strong rise. Where could seller stops be? When do sellers start losing control? Third, buyer capitulation at level. Price to level, first reaction, second rise attempt. Movement doesn't develop, breakout down. Why couldn't buyers develop movement? When does initiative shift to sellers? Fourth, breakout preparation. Attempt to fall, selling doesn't develop, return to range, approach to resistance, first breakout attempt, impulsive breakout on second. Why breakout more often on second attempt? Fifth, price rejection above level. Attempt to hold above resistance, impulse, pullback, new attempt. No continuation, consolidation, breakout down. Why doesn't market accept price above? What signs of seller appearance? Goal of assignments? Learn not just to recognize patterns on picture, but understand participant behavior logic. Where struggle, where liquidity gathers, where capitulation happens. What's next? All these patterns share one idea. Market constantly moves between liquidity zones. It searches where stop orders, where new positions, where participants will be forced to close trades. When you start looking at market through this logic, chart stops being random. You see struggle of buyers and sellers. And exactly this understanding lies at foundation of professional trading strategies. Write in comments, did you know these patterns before or encountering for first time? Next session, we'll create your first setup, entry rules system from scratch. Because patterns are tools, but without clear algorithm, they don't work. Don't miss it.